The Wendy's Co. Warren Buffett-style investment analysis. 1. Business quality and economic moat. Business model. Wendy's operates as one of the world's largest quick-service restaurant QSR chains, blending company-owned and franchise restaurants. The company's revenue streams include direct sales from company-operated restaurants, franchise fees and royalties, real estate leasing to franchisees, supply chain operations, and advertising fund contributions. Competitive advantages, brand recognition. Wendy's enjoys 91% brand awareness in the U.S., with a reputation for quality and a distinctive, engaging social media presence. Menu differentiation. Signature items, square burgers, frosty dessert, frequent menu innovation, and a value menu, for example, Biggie Bag, set Wendy's apart from competitors. Quality focus. Emphasis on fresh ingredients and superior product quality. Digital engagement. Strong digital sales growth, nearly 30% in 2023. A popular loyalty program and effective digital marketing. Franchise model. The franchise-heavy approach enables scalability and operational efficiency, with franchisees providing local market expertise and capital. Sustainability initiatives, commitment to reducing greenhouse gas emissions and sustainable packaging aligns with evolving consumer values. Economic moat. Wendy's possesses a moderate economic moat. Brand and customer loyalty. Strong, but not as deep as McDonald's. Menu innovation and quality. Provides differentiation, but can be copied by competitors. Franchise network. Offers scale and efficiency, but is not unique in the industry. Switching costs. Low for consumers, so moat is not unassailable. Conclusion. Wendy's has a real, but not wide or unassailable moat. Its brand, menu innovation, and franchise system provide competitive advantages. But the fast food industry's low switching costs and intense competition limit the durability of its moat. 2. Management quality, leadership, credibility, experience. Wendy's executive team and board have significant industry experience, with long-tenured leaders in key roles, CEO, CFO, COO. Track record. Management has successfully expanded the restaurant base, driven digital transformation, and launched new menu segments, notably breakfast, demonstrating adaptability and vision. Crisis management. The team navigated COVID-19 disruptions and supply chain challenges with resilience, maintaining profitability and growth initiatives. Capital allocation, reinvestment. Management invests in new store openings, digital platforms, and menu innovation. Shareholder returns. Wendy's has a history of regular dividends and share buybacks, signaling a commitment to returning capital to shareholders. Debt management. The company uses leverage prudently, balancing growth with financial stability. Franchise strategy. The shift toward a higher proportion of franchise stores has improved margins and reduced capital requirements. Shareholder alignment. Insider ownership, while not extremely high, insider ownership is meaningful and aligns management with shareholder interests. Insider buying is generally a positive sign, and there have been no major red flags from insider selling. Transparency. Management communicates clearly through annual reports, earnings calls, and investor presentations. Conclusion. Wendy's management is credible, experienced, and generally well aligned with shareholders. Capital allocation has been disciplined, with a focus on long-term value creation. 3. Financial strength, revenue growth. Wendy's has demonstrated steady revenue growth, driven by new restaurant openings, menu innovation, and digital sales expansion. Analyst estimates suggest a 3-year revenue CAGR of approximately 5%, slightly above the industry average. Profit margins, gross profit margin, approximately 36% example calculation. Operating profit margin, approximately 12%. Net profit margin, approximately 8%. These margins are healthy for the QSR sector, though not industry-leading. Return on equity ROE and return on invested capital ROIC. ROE, approximately 25% example calculation. Actual value should be confirmed from the latest 10K10Q, ROIC, not directly provided, but typically strong due to the franchise model's capital efficiency. Debt levels, debt-equity ratio, approximately 1.5. Example: actual value should be checked in the latest filings. This is higher than Buffett's ideal less than 0.5, reflecting the capital structure common in the restaurant industry, especially with a franchise-heavy model. Free cash flow FCF, consistently positive and growing, with digital and delivery channels contributing to cash generation. FCF is sufficient to fund dividends, buybacks, and reinvestment. Conclusion: Wendy's financials are solid, with strong ROE, healthy margins, and robust free cash flow. The main concern is a higher-than-ideal debt-equity ratio, which is mitigated by stable cash flows and the franchise model. For intrinsic value valuation metrics, PE ratio, approximately 22.5x. Example: check latest data, PB ratio, approximately 5.1x. Example: both are slightly below industry averages, suggesting a fair or slightly undervalued position relative to peers. Discounted cash flow DCF, owner's earnings DCF approach, using a conservative FCF estimate, for example, $250 million. Modest growth, 3 to 5%, and a discount rate of 10 to 12%. The intrinsic value per share is likely close to or slightly above the current market price, for example, $25 share. Margin of safety. The current price offers a modest margin of safety, but not a deep discount. The valuation is reasonable, but not a bargain basement Buffett-style buy. Conclusion: Wendy's is fairly valued or slightly undervalued based on conservative DCF owner's earnings analysis. The stock is not deeply discounted, but offers reasonable value for a quality business. 5. Long-term prospects. Industry outlook: the fast food industry is stable and resilient, with long-term growth driven by convenience, digital transformation, and international expansion. Key trends include health, wellness, sustainability, and digital ordering. Risks: labor costs, rising wages and staffing shortages squeeze margins. Commodity prices, volatility in beef, chicken, and other inputs can impact profitability. Consumer preferences, shifts toward eating at home, health-conscious choices, and value-seeking behavior require constant adaptation. Competition: intense rivalry from McDonald's, Burger King, and fast casual chains. Franchise consistency: maintaining quality and brand standards across a large franchise network is challenging. Compounding potential: Wendy's has opportunities to reinvest in digital, menu innovation, and international growth. The franchise model supports scalable, capital-light expansion. The company's ability to adapt to consumer trends and leverage its brand should support long-term compounding, though not at the highest rates in the market. 6. Final verdict: Buffett-style assessment. Buffett's standard current status: Wendy's pass. Understandable business: yes. Simple, franchise-driven QSR model: yes. Consistent earnings: yes. Stable. With steady growth: yes. Good ROIC: yes. ROE approximately 25%. Strong capital efficiency: yes. Low debt: no. Debt equity: approximately 1.5. Above Buffett's ideal: no attractive valuation, fair to slightly undervalued. Not a deep value, partial long-term moat. Moderate, brand, innovation, franchise scale, partial trustworthy management: yes. Experienced, aligned, disciplined capital allocation: yes. Overall verdict: Wendy's is a high-quality, understandable business with a strong brand, consistent earnings, and solid management. Its franchise model and digital transformation provide competitive advantages. But the economic moat is moderate due to intense industry competition and low switching costs. Financials are robust, with strong ROE and free cash flow, though leverage is higher than Buffett's ideal. The stock is fairly valued, offering reasonable but not exceptional margin of safety. Wendy's fits many Buffett criteria, but is not a classic wide moat, deep value opportunity. It is a solid long-term hold for investors seeking stable compounding in the QSR sector, but may not be a top pick for strict Buffett-style deep value investors. Summary: Wendy's is a well-managed, resilient business with a moderate moat, strong cash generation, and reasonable valuation. It is a good candidate for long-term investors. But leverage and industry competition temper its appeal for the most conservative Buffett-style portfolios.